The financial media is currently obsessing over central bank chatter and minor quarterly earnings reports. But while the world was looking the other way, a structural severing of the North American supply chain has just occurred in almost complete silence. The Mexican government has announced a sweeping new framework targeting the export of raw ore and refined silver. This is not a temporary supply hiccup. Mexico is the single largest producer of silver on the planet, responsible for roughly 24% of total global mine supply in recent years. And they dare actively positioning to turn off the tap for processing facilities across the United States and Canada. You are watching the opening move in a massive geopolitical restructuring of how critical wealth and resources flow around the world. The banking cartel has spent decades suppressing the price of this metal on paper, but they are terrified of what happens when a physical deficit of this magnitude collides with their illusions. If you are someone who understands that true wealth is measured in ounces and not digital digits, make sure to hit the subscribe button and give this video a thumbs up, because the history of manipulated markets shows us exactly how this ends, and I want you to be prepared. Let me break down exactly what this new legislation does, because the few mainstream financial outlets that actually bothered to cover it have been painfully imprecise, and in some cases, they are outright misleading their audiences. The Mexican government has not just tweaked a tariff. They have announced a tiered export restriction framework under new legislation that officially classifies silver, alongside lithium and other rare earth minerals, as a strategic national resource. This specific legal classification triggers a series of automatic, unavoidable policy consequences that most outside observers, and frankly most Wall Street analysts, have not fully processed yet. First, the raw ore and silver concentrate exports now require individual government authorization on a shipment-by-shipment basis. Previously, massive mining conglomerates operating in Mexico could export freely under general operating licenses. They would pull the wealth out of the earth and ship it out by the ton. Now, every single significant shipment requires a separate, grueling approval process through their Ministry of Economy. Second, the government has implemented strict volume caps on refined silver bar exports. Industry insiders estimate this specific threshold represents an immediate reduction of between 15 and 22% from recent average monthly export volumes. But it is the third point that is the most devastating for North American supply chains. The restriction includes what is called a preferential domestic processing requirement. This means that a rigidly defined percentage of all silver mined in Mexico must now be processed and refined within Mexico before it is legally allowed to be exported. It can no longer be shipped as raw, cheap concentrate to massive processing facilities in the United States and Canada. To understand why this is catastrophic, you have to understand how the North American silver supply chain was actually built. For decades, it has operated on a very specific, highly profitable model for foreign corporations. Mexican laborers extract the ore. That raw ore gets loaded onto trains and ships as a cheap concentrate, heading straight to smelters and refiners in places like Texas, Montana, and across the Canadian border. Those facilities in the United States and Canada process the concentrate into pure, refined silver, upgrading its value massively, and then sell it into the broader global market. This model developed organically over half a century because the heavy processing infrastructure in Mexico was historically less developed. The multinational mining companies found it economically optimal to dig the hole in Mexico, but keep the high-paying refining jobs, the value addition, and the tax revenues in their own countries. The new Mexican mandate fundamentally shatters this economic model overnight. Mining companies operating in Mexico now face a brutal choice. They can either build or contract domestic processing capacity inside Mexico, which takes years of permitting and hundreds of millions of dollars in capital investment, or they can drastically reduce their production because exporting the raw concentrate is no longer legally viable at their current volumes. Neither of these options resolves the immediate supply crisis for North American buyers. Now, let me give you the terrifying scale of what is actually at stake here. The United States consumes approximately 150 million ounces of silver annually across all uses. Think about that number, and roughly 50% of that massive demand is purely industrial. We are not talking about jewelry. We are talking about the critical components required to run a modern empire. Electronics, solar panels, electric vehicle battery management systems, advanced medical devices, water purification systems, and heavily classified military guidance systems. These are the primary industrial consumers of the silver entering the United States market. Industry estimates suggest that Mexico is the origin point for somewhere between 35 and 45% of the physical silver that ultimately enters United States industrial supply chains. That is not a marginal input. That is a structural dependency. It is the beating heart of their manufacturing sector. If you cut off nearly half the oxygen to a patient, they do not just get a little dizzy. They go into shock. And this is where we have to peel back the layers and look at the psychology of why this is happening right now. The academic phrase that gets thrown around is resource nationalism. But what does that actually mean in the real world? Resource nationalism is what happens when a sovereign government looks at its finite mineral wealth and finally realizes that foreign corporations and foreign buyers are capturing entirely too much of the economic value, leaving the domestic citizens with nothing but empty minds and environmental cleanup. It is the moment a nation realizes they have been trading their tangible, physical wealth for paper currency that foreign central banks are printing to infinity. They see the inflation, they see the devaluation of the dollar, and they make a strategic calculation. If they are going to part with real, irreplaceable assets, they want to capture the entire value chain. We have seen this exact playbook run recently, and the results were violent. In 2020, Indonesia looked at their position as the world's largest nickel producer. They realized they were leaving billions of dollars on the table by exporting raw nickel ore to Chinese processing facilities. So, they instituted an outright ban on raw ore exports. The immediate result was a severe supply disruption that sent shockwaves through the electric vehicle supply chain. The secondary result was that foreign corporations were forced to pour massive direct investment into building Indonesian refineries. Indonesia captured the wealth, but global markets bled in the process. Or look at China in 2010. China controlled roughly 97% of global rare earth element production. They implemented export quotas, claiming they needed to protect their environment and conserve resources for domestic use. The actual effect on the global market was an immediate and violent repricing of every single rare earth element. Neodymium, a critical input for magnets, went from around $20 per kilogram to over $400 per kilogram in just 18 months. Dysprosium went from $100 to over $2,000. Entire supply chains were paralyzed. But here is where the silver situation becomes far more explosive than nickel or rare earth elements. And this is the dark, undeniable truth that the financial media refuses to discuss. Rare earths and nickel are almost exclusively industrial materials. Nobody is buying physical neodymium coins to protect their family's wealth from a collapsing currency. Silver has a dual identity. It is an indispensable industrial necessity, but it is also a historical, monetary asset. And for decades, the global banking cartel has managed the price of this asset through a massive, artificial paper market. They trade hundreds of digital, unbacked derivative contracts on the commodity exchanges for every 1 physical ounce of silver that actually sits in a registered vault. It is a beautiful, highly profitable illusion that allows financial institutions to suppress the price, keeping the broader inflation narrative safely hidden from the public. But you cannot build a solar panel out of a paper futures contract. You cannot put an unbacked digital token into the guidance system of a Tomahawk missile. The industrial giants like Apple, Tesla, and massive defense contractors do not care about the paper price on a screen when their factory lines are threatening to shut down. When they realize the physical supply from Mexico is actually drying up, they will panic. We have seen glimpses of this dual demand squeeze before, most famously in 1979 and 1980. During that period, the supply disruption was heavily influenced by individuals demanding physical delivery of the metal rather than just settling for cash. When the Hunt brothers and other investors simply asked for their physical property, the major exchanges were brought to their knees. The paper market makers realized they did not have the metal. The illusion was breaking. The price rocketed to $50 an ounce. To save themselves, the banking cartel literally had to change the rules of the free market, implementing liquidation-only rules to force the price back down. But today, the catalyst is completely different. It is not a few wealthy oil tycoons in Texas demanding delivery. It is the largest producing nation on planet Earth deciding to lock its doors and keep the metal for itself. You can force a retail investor to settle a contract in cash. You cannot force a medical device manufacturer to settle in cash. They need the physical metal or their business dies. When desperate industrial procurement managers are suddenly forced to compete with global investors for a violently shrinking pool of physical Mexican silver, you get 2 simultaneous demand pressures operating against a collapsing supply base. The paper manipulation mechanics will simply break under the pressure of cold, hard physics. If you want to know how close we are to this breaking point, you do not look at the spot price on your screen. You look at the lease rates. The lease rate represents the true cost to borrow physical silver for short periods. It is primarily used by industrial manufacturers who need metal immediately to keep factory lines running, and by massive financial short sellers who desperately need to borrow physical metal to cover their underwater positions. When physical silver becomes scarce, lease rates skyrocket. A sustained, violent spike in silver lease rates is the ultimate warning siren. It is the clearest technical signal that the physical market is tightening its grip around the neck of the paper market. And the Mexican government just handed the physical market a very heavy rope. The history of commodities tells us a very simple, very brutal truth. When a sovereign nation decides to hold on to its tangible wealth, the empires that were built purely on paper always begin to crumble. Mexico has just drawn a massive line in the sand. This is no longer just about silver. This is about a global reawakening to the physical reality of the world we live in. We are moving away from a long, artificial era where wealth was defined by how much debt you could leverage on a computer screen, and we are entering a painful era where wealth will be defined by the actual physical elements you hold in your hand. The financial engineers on Wall Street have spent decades building an intricate house of cards, and they have relied entirely on the quiet compliance of producing nations to keep the wind from blowing it down. But the wind is picking up right now. The supply lines for North America are being structurally severed. The industrial panics are just beginning to surface behind closed doors at major technology and defense companies. And when the music finally stops playing, you do not want to be the one holding a digital promise from a bankrupt commodity exchange. You want to be holding the exact asset that the entire system is desperately trying to acquire. If this changed how you see the financial system, hit the subscribe button and leave a comment below with your thoughts on where this is heading. The data is out there in plain sight. Your job is to read it before the mainstream media catches up. I will see you in the next one.